Welcome to Be the Boss of Your Money. We have a lot to talk about. Holy, you know what? Stocks got absolutely crushed today. No sugarcoating it. This was a rough day. Holy shit, man. This was a rough day. We have a lot to talk about. Target, comments that the CFO made about inflation and prices. Uh, there was so much carnage in the street today. We had that bounce back on Friday, 2 up days, people thinking we could have a good week. Mm-mm. We are right back to the lows of this current market dip. And, I think we have to call it at this point. If we are not in a recession, it's going to feel like we're in a recession. So, what's the difference? I'm going to say now, and I talked to somebody about this morning. I wasn't really sure. I can give you the reasons why I think we're in a recession. Uh, I think it's begun. I really do. I think if you're still asking yourself, are we in a recession? I think after today, I am in the camp that we are, and it's not because I'm like all down and negative and beat to crap today because of the stock market. No, no, that's not why. I mean, yeah, the stock market doesn't beat me up, by the way. Okay, just want to let you know, hey, nobody beats up Mitch. All right, no, no, the stock market does what it does, and I don't really get too flustered one way or the other. I'm pretty calm about the market, but what I find interesting are facts and figures behind it. So we'll talk about this in a moment. Are we in a bear market? Yeah, we're in a bear market. I mean, it's a generally strong downtrend in stocks, which is reinforced today. And we've talked about this. The biggest rallies come during bear markets, and they go up enough and last long enough, just enough to suck you into them, only to crush you again. And it happens over and over. This week was no exception. I didn't touch a thing. I did not buy a single solitary stock the last couple of days, not for myself, not for a client, nothing. Because, like I've been saying, rallies are subject, rallies are suspect. We don't trust the rallies. We need a lot of things to happen in order for a market bottom to stick. And we're not seeing it yet. So we're going to talk about what happened with Target. Just it was really just like the most disastrous thing in a stock that a lot of investors owned for its quote unquote safe haven status. All right, let's roll the intro, and we'll have enough. We'll have more superlatives of how we could describe the market. Sorry, I cursed a couple of times. It's just one of those days. I feel like it calls for it. While you're watching this, if you do have any questions, please hit me up in the comments. Your words of wisdom, words of encouragement are always appreciated. If you don't mind, give us a thumbs up, a heart, a wow, a like, whatever it is. Let me know you're out there. It helps me spread the show around. It helps people see the show in the instant replay, which will be on my timelines forever. We're streaming right now to YouTube, LinkedIn, Facebook, and Twitter. And I will post clips on all of those platforms, short 1 or 2 minute snippets from the shows. And I also post every single day on Instagram as well. So if we're not connected there, please follow me at InstaMitchG. And if we're not connected on LinkedIn, if you're active on LinkedIn, we must connect. If you're not, if LinkedIn's not your thing, that's okay. But if you are on LinkedIn, you are active in any way, shape, or form, if you just check LinkedIn, just let's say once a day, we need to be connected because I am there all the time. That is my main jam. All right. So here we go. And I cannot wait to get into this. We already have a question out there from Roy, which we will hit right after. We'll answer, I should say. We'll answer right after the intro. Here we go. Okay, thank you so much for joining me. We're just getting started. This is Mitch Goldberg. You're watching my show, Be the Boss of Your Money. Roy, I see your question out there. Roy is the first person to call me Mr. 430, and I greatly appreciate that. Jerry is out there as well, so let's take it to the comments first. Okay, I want to. This is the best part of doing this. I love fielding your questions. What's your definition of a recession? Damn, I wish I got that question before the show so I could really have like a cohesive answer. And it's morphed over time, which is why I don't just come out and say my definition of a recession is 2 quarters of negative GDP in a row. That is a technical term for a recession, but during the pandemic in 2020, we had a recession that lasted 6 weeks, which was considered the shortest recession on record. Now, there are people who suffered through the recession, through the pandemic, who will say they were in a recession for a lot longer than 6 weeks. We all know that. My definition of a recession is basically an economy that seems to be slowing down quickly, not just leveling off, not going from an economic recovery to an expansion to a flat line. I don't even think we're flatlining. I think based on how consumers are using credit cards more and more to purchase things, there's been like a massive increase in new credit card accounts since the beginning of this year. And with inflation rising, no more stimmy checks coming out, Fed raising rates. Uh, I think all of those things put us in a recession. Difficult to find things that we need. Yeah, all of these things scream economic slowdown. And I hear what people say, "Oh, we've got all these job openings, like 11 million job openings." That'll be like the first thing to disappear. All a company has to do is just change their ads or their, whatever they're advertising on LinkedIn or Indeed, whatever, and those job openings disappear very quickly. Companies have already begun instituting hiring freezes, and there's a lot of that going on. And then after that, they start with the layoffs. Even Robinhood has announced layoffs. The big mighty stock trading app Robinhood, who was like the darling of the whole, the purveyor of the whole pandemic stock market run, and in crypto as well. So I hope that helps. It's not the most clear-eyed definition, but I do think that different economic circumstances with different conditions often warrant slightly different answers, because even though things repeat themselves, there are some things that are a little bit different. I'm not saying it's different this time, but we've never really had a market like the one when we had it. The closest example I could get to is the year 2000, 99, 2000. Like in the year 2000, we had Y2K, people were replacing computers like crazy because they were worried about their computers stopping when the clock turns to 2000, because people thought that everything electronic would be reset to January 1st of 1900, not January 1st of 2000. The Fed pumped in a ton of money into the economy, and that money found its way into stocks. And the highest duration stocks, companies with no money or companies trading on eyeballs or price to sales ratios, went up a lot, went up the most, and they tanked, and they took everybody down with them. All right. So having said that, I've been talking about this a long time, that, we're seeing the smaller stocks get crushed, but you haven't noticed it because the major averages like the S&P 500 has been holding up. You can't invest directly into an index like the S&P 500, but you could invest into a security that tracks or mimics the index. Now, the big stocks, the Apples, the Amazons, Nvidias, they held up really well. So they masked the deterioration underneath them. So what's happened is the selling is finally caught up to the mega cap stocks. And now that they're going down hard and fast, they're bringing the headline index figures down with them. Okay. Bob is out there. Thank you, Bob. I'm Brian Westbury, market update call at 10 a.m. today. He's still bullish for the next 12 months. Year-end target S&P 4,700. Sees your session in 2024. Watches M2 3% 10-year treasury, 15% profit growth equals market fairly valued. What are my thoughts? I think that's overly optimistic. I will say this: the sooner we go into a recession, the sooner the stock market will bottom and recover. By the time we acknowledge, not by the time we are in a recession, the NAIB, the body that actually declares the beginning and end of recessions, by the time they declare it, and by the time we as investors and consumers acknowledge that we're in a recession, stocks will have already bottomed and they'll be trading up. And that's when I want to pound the table and say, you got to up your risk exposure. All right. I said I would give you my best advice ever, so I'm going to do that in 1 second, but I'd be remiss if I didn't take James Wrigley's comment. Jimmy, hey, Mitch, enjoying your updates during this time. Our Australian market isn't down as much as yours. Well, I'm happy for you. That is a good thing. Relative outperformance in the land down under. James is in Melbourne, Australia, a financial advisor there. And by the way, congratulations on your recent, I guess, partnership, what have you, in your firm. So that's all good news. Every market's a little bit different. Australia is very big on minerals and natural resources, and probably inflation, I would imagine, would be good for the Australian market. Correct me if I'm wrong. Iron ore and all that stuff that you guys mine and then ship to China. Okay, but that's good that the Australian market is holding up. Aussie. All right. So what's my best advice ever? Should I switch camera angles for this? I don't know. I'll just go with this. So here's my best advice ever. Okay. I almost don't want to give you the best advice ever because then there's no reason to pay attention to me. All right. I'm going to give you my best advice because I was asked a number of times over the weekend. I went to a bat mitzvah over the weekend, and people know what I do. They asked me, did you get out of the market? Like, I don't even did I get out of the market? And then people always follow, well, I think it goes lower, or I think it goes higher, or I think this is the bottom. People are just guessing, and those who guess right will actually have their guess validated, which will then turn into an over assessment or an it'll make people become overconfident in their perception and intelligence. Does that make sense? Because even when a bad decision is validated as a good decision, or a total guess is validated, people feel smart for that. And once people feel smart, I think we all know that feelings are more important than actual knowledge, right? It's hard to counter misinformation when people believe in their view strongly. We all know that. So here's what my answer now. Okay, as far as I'm concerned, and for my clients, we set aside an emergency fund 6 months to a year in cash. Now, some people, it's more than a year. Some people, it's less than 6 months. It depends. It depends on one's age. It depends on how steady one's income is. The more steady and trustworthy and stable your income is, like somebody who's retired and collecting a phenomenal pension and their Social Security, maybe they don't really need to have as big of an emergency fund. And then you take somebody who is in transactional sales business, like a commercial real estate broker, that person would probably, and I know, should have a bigger emergency fund because it could be a while until they get their next transaction, until they lease or sell another property. So having said that, you've got your emergency fund Then you've got your cash set aside for short-term needs, let's say over the next year or two, for your health insurance, for your rent or mortgage, what have you. And after that, the rest of the money is invested for the long term. Long term. That does not mean being able to figure out that you should have gotten out of the market middle of last week and gotten back into the market this week because now it's going all the way up and you were totally wrong and you totally misjudged it. And we freaking plunged today. Today was a hugely down day. This is I don't use hyperbole like that often, like hugely down day. I don't get flustered, but you have to admit when it's a really big down day. So that's what I'm thinking. All right. I've got my emergency fund and my expenses covered. And the rest of my money's invested. It's invested based on, just like it should be for you, based on your time horizon, your risk tolerance, and your goals. Now, your time horizon to your financial goals is what determines your risk tolerance. The more time to a financial goal, the higher your risk tolerance. The less time, the lower your risk tolerance. That's my answer. But people don't seem to be interested in this common sense, somewhat boring answer. People want to sell and they want to buy at the bottom and just make all kinds of crazy good money because you're going to catch it on a new wave up. Good luck. If you want to do it, good luck. You could try. You could try with a portion of your funds, but you could do that successfully 10 times. You only have to do it wrong once to blow up the whole track record. Okay. All right. I'm getting a little too into that. I want to show you my post today. I think this is like a new thing I'm going to do. I'm going to post my LinkedIn post on the show. Let's go over here. Let me pop myself up in here. I'll take out these emojis. There we go. That's better. I'm going to make this a little bit bigger. All right. This is the statement from Target CFO that is crushing the stock. And I'm going to say that is crushing the stock market as well. With inflation at a nearly 4-decade high, Chief Financial Officer Michael Fidelki said on a call with reporters that Target will focus on offering value, even if it means absorbing some costs. He said raising prices continues to be the last lever we pull. We've earned so much trust over the last several years with investments that we've made in price, and we aren't about to trade that out in the current environment, he said. And here's what I wrote, Wall Street's interpretation. You see the scary emoji? If you don't raise prices and you're willing to just sit back and wait for inflation to subside, then you're basically giving up on earnings and margins. Get me out. This is really bad. And to me, this is why Target went down. Target is not raising prices. Look, I think it's good that Target is focusing on, and I put my hashtags Target, Walmart, and inflation. Hey, connect with me on LinkedIn and you'll see more content like this, okay? Seriously, I'd love for you to connect with me on LinkedIn if we're not already connected, or Facebook. So, how do I say this? If you're not willing to raise prices and your cost of goods go up, then you're basically giving up on margins and earnings. And that's a recipe for poor financial performance. It makes forecasting the next few quarters of earnings and revenues impossible. Investors hate that. They hate uncertainty. And now you want to get out of the stock. Not every shareholder sold the stock, but enough shareholders sold the stock, obviously, to knock the stock down by a whopping 25%. Target is not the kind of stock that moves up or down 25% in a day. Now, I could see that happening with a tech stock or a biotech stock, but this is Target, and Target is one of the stalwarts of the stock market that investors go into when they're worried about volatility. So the place where investors feel safe burned them. And that's why Target really, really hurts so bad. But this is not, I don't, I've been having this debate, not a debate, but people commenting. I applaud Target for not raising prices and taking care of its customers. And I applaud that long-term thinking. But I also think that if Target could raise prices and if Target was not worried about losing business to its competitors, Walmart, Costco, it would. I don't think it's as altruistic as people think. I just think that they can't lose volume because if they lose volume and their margins are down, it's a double whammy. It hurts even more. It's just the way the math is going to work. So they're keeping prices low, not because Target wants to go into the not for profit sector. It's keeping expenses low because it feels that losing customers or losing business to Walmart is worse than having bleeding margins, than having deteriorating margins. That's what this is all about. It sent a shockwave through the retail space. And I'll show you what I mean. All right, I'm going to make this a little bigger. All right. Target. You see Target down 54 cents, no big deal, but that is aftermarket. What I'm looking at is this. Target down $53 to 161, down 24.93%. Do you see that? That is a blast. 52-week low down from 268. That's like a $28 stock going to 16. Walmart, which got crushed yesterday, was down another 7% today. So Walmart was flying high at 160. Now it's 121. And this is an ouch. Costco down 12.45% at 429. I kid you not. I think we're far enough away that I could say this without risking the ire of compliance, Rita. Okay. I sold some Costco for clients in the 600s, thinking that probably selling it too soon, but prudence means you take some off the table. Got to raise a little bit of cash. Got to find the right places to raise the cash. And, discipline is more important than because you think the stock because you have a feeling about a stock. So I sold half. And I cannot believe how much it's down. Of course, now I wish I sold it all, right? But these stocks are great companies. If they're not willing to raise prices, though, and they want to absorb higher costs, you just have to know as an investor that you are literally, I hate when the screen blinks, that you are literally giving up profit margin, and this company's earnings will most likely be much, much lower than analyst expectations. All right. So today is the fifth decline this year of more than 800 points. And do you remember when this whole thing started? A little history. The day after Thanksgiving, when Fed Chief Jerome Powell came out and said, we have to start considering pulling back on stimulus. And the Dow dropped almost 1,000 points the day after Thanksgiving last year. And that's when this volatility started. And it's just continuing. So now we've been in, 6 months plus of a very volatile market. I don't think investors have been feeling it, again, because the major averages like the S&P 500 have been holding up. But now that the S&P 500 surface, not the deterioration below the surface. People just look at the S&P 500. They don't look at what's happening underneath the surface. They thought everything was cool, and it's not. And here we are. All right. So let's take a look at the boards here. I call these the boards. Dow down 1,164 points, down 3.57%. NASDAQ down almost 4.75%. That is a big day. Look, I always tell you, a 1% move in the averages gets my attention, okay? Excuse me. This is not TV. It's streaming, so I could scratch my ear if I want. All right. But the S&P down 4%. That is a big day. That is a very big down day. Gold down a little bit, so no safe haven status. Oil finally came in a little bit. It's been going up lately. The 10-year treasury the yield was down, which means bonds are up. So investors bought some bonds. Well, why aren't interest rates supposed to go up? The 10-year treasury did cross above 3% for a brief moment today, but it is acting as but it's acting like a flight to safety in a small way. So investors decided they're panicking and they're putting money into bonds. You really have to be panicky to throw your money into a 10-year treasury right now. I could see throwing your money into a money market or a 90-day T-bill or a 90-day CD, but a 10-year treasury, that's you've got to be really freaking nervous to do that. The VIX was up 18%, not as much as I thought. 31. We see 35 or so, which has been the peak of the VIX spikes. If we see it break above 35, let's say 37, 38, you can bet the next headline will be we have officially entered into a bear market. Even though the S&P 500 is not 20% off its high, the S&P closed at 39.23. 38.55 is the level that it has to get to be an official bear market. We just missed it last week. Maybe we'll hit it tomorrow. We have to see. Okay. Cisco down over 13.5% aftermarket trading, came out with numbers. They missed on revenue. They beat on earnings, but only by a penny. It was not considered a high quality report. And the stock was down 4.5% during the regular trading. So not good things heading into the tech space tomorrow. So let me explain. Cisco, yeah, they're having supply issues getting with semiconductors and the elements that are used to make tech products. But there's something else we need to consider. We talk about DoorDash, we talk about Zoom, we talk about all the pandemic stocks. These companies are way down. Business for a lot of these companies has already peaked because we're through the pandemic. Target is basically saying that. Target is saying our suitcases are selling 50% above a year ago. But toys are for parties, party goods are selling. But things that people were buying to work from home and stay at home, like TVs and computers, those are going down. Anyway, the pandemic stocks, these consumer-facing tech stocks, they are big buyers of consumer products. So if those companies suffer, Zoom and again DoorDash, I pick on these companies because they're the first ones that come to mind. But you have to understand, if they suffer, they're part of a food chain. We as consumers suffer. DoorDash suffers, and then DoorDash cuts back, and they spend less money on technology. And that affects Cisco and chip manufacturers and fiber manufacturers and everybody down the line. And it just becomes a really bad cycle. That's how it works. Let's keep going. The market movers of the day reads like a oh my God list. Target down 25%. Dollar Tree down 14%. Old Dominion Freight down 13%. Tractor Supply down 12%. Costco down 12%. Costco going down 12% is an awful lot. This was a really horrendous day. Stocks like SJM, the jelly company, okay, down over 10%. The stocks that you buy as a safe haven are the ones that are hurting you now. And that's why this market stinks so bad. Now, is it bottoming? I mean, I think that's the big thing everybody's talking about, is the stock market bottoming. It could be bottoming. I don't think investors have puked up stock enough. It doesn't feel like it's a panic yet. It doesn't feel like people are just getting out of everything. Yes, almost everything was down. I think out of 500 stocks in S&P, 8 of them were up. But I don't feel capitulation. I don't feel all out panic that the world is ending, that the stock market will never recover. And also, I think you have to Wait for people to get their May brokerage statements, and then they'll really see how bad the market's going. And there's a lot of people. There are a lot of people who just get quarterly statements. A lot of people, they're walking around looking at their March statement of 2022, and they have no idea how much stocks have gone down since then. Wait till they get their June statement. Unless things turn around substantially in the next month and a half, when people get their June statement, they're going to be in for a cluster headache when they get those. All right. So that's what I see coming up. Let's keep going. Costco, again, we're looking at Walmart down 9% after being down about 10% yesterday. These are huge drops for these companies. Costco down 12.5%. Dollar Tree down 14.5%. Is there any safe haven status anymore? You have to wonder, right? Let's take a look at consumer staples. This is a place where people are hanging out, right? For safety. Colgate Palmolive down a lot, almost 4%. B&G Foods down over 5%. CVS down over 5%. Constellation Brands down over 5%. Kellogg's down over 5%. There was a lot of perceived safety in these investments. Pepsi down 6%. How often do you see Pepsi and Procter and Gamble go down 6%? It's like it's a rarity to see these stocks go down that much in a day. But there are a few funky things, not a lot of liquidity, a little bit of panic. But again, I don't think this is like the panicky swoosh that we're looking for when we talk about capitulation selling. Let's look at treasuries. Treasury securities went up a little, yields went down. The yield curve is not too far from being flat. The difference between the 2-year and the 10-year is about 22 basis points. Not a lot. It's not too far from getting flat. When the yield curve gets flat, meaning when the 2-year treasury and the 30-year and the 10-year treasury are yielding the same, that means it's flat, and that's an indication of weakness and no confidence in the economy. I'm not even sure why I look at crypto anymore, but crypto hit like 27 or something the other day, but down 940, down 3%, as goes Bitcoin, as goes the rest of the crypto space. And again, Cisco, we looked at that. Cisco down 13% and aftermarket trading. So that's about it. That's my story. I'm sticking to it. Tough day. I don't see anything particularly great on the horizon. Earnings aren't enough to lift the market. There's no help from the Federal Reserve. But if we do finally go into a recession that we finally acknowledge, I think that's when we could scream bottom and feel comfortable about buying stocks. That's what I'm looking at. If you guys have any questions, definitely hit me up in the comments. Any more questions? I always appreciate that. I will see them, and I will see you guys tomorrow, and I really appreciate your support. Thank you.